Stay tuned for this month's edition of Common Sense, where we're going to talk about popular credit myths. Welcome back to Common Sense, the monthly TV show here on cable channel 17, where we talk about issues that are related to the business world and the banking industry. Ryan, it's turning into fall on us already.
It is. I just noticed on the way down, leaves are starting to turn, and it seems like they started overnight. Ready for some fall-like temperatures, though.
It's kind of a cool, cloudy day outside, not so hot, but I think we're still in for another week of some pretty warm weather to wrap fall up. Business is picking up here in the Rio Grande area with the Fall Festival coming up across the road.
School's back in session, so
lots
of things happening.
Getting busy. Before long, it'll be snow flying.
I know.
So, anyway, today on our show, we have back a popular October guest. We have Chris Preston with Ohio Valley Bank. Chris is in branch administration there at the Ohio Valley Bank and also in charge of some of the business development programs. So, Chris, welcome back to our show.
Thanks, Jim. I'm excited to talk about credit today.
We're glad to have you back. So,
we've got, I know, credit, lots of myths and lots of questions about credit. And I think we've got someone on the show today that can really provide some answers and solve the myths or bust those and actually give us a plan to help better our credit scores. But before we get started, do you want to tell us just a little bit about yourself and where you're working at Ohio Valley Bank?
Absolutely. Sure. So I'm originally from Gay County. I live in Cabell County, West Virginia. I'm branch administration, as you talked about, business development. I have an opportunity to oversee 3 of our wonderful locations, including Barbersville, West Virginia, Milton, West Virginia, and Pomeroy, Ohio. So have 3 great branches that are doing really well and tremendous managers and staffs there. Part of my job is obviously to get out and about and do some business development, meet with some people in the community. And part of my job, I get to serve on several boards within the community to help out those organizations as part of the Ohio Valley Bank. So, yeah, it's a good job. And a better part of my career, I've been involved in credit. So I'm anxious to dispel some myths today.
Right. And we've talked about, all of our shows in the past, how Ohio Valley Bank is such a community-minded bank. And I think just, what you said, being able to get out in the community and meet with folks and help them understand, things like doing this show. This is be a great episode for businesses to tune into and, just to provide some information to the general public. So
absolutely.
Right. Yeah, as you talked, and I talked a little bit earlier, Ryan, a lot of these things that we're going to cover today, when we work with the individual business clients through the Small Business Development Center, in preparation of someone getting a loan, the conversation of credit inevitably comes up. How's your credit? What's it look like? And that brings up a whole nother set of questions that those business owners or potential business owners come to us with. They have a lot of questions.
That's right.
So these are some really good questions that Chris has come up with for today, the things we're going to talk about.
We were talking earlier before the show started, and anytime we teach an access to capital class or we start talking about credit scores, how they're determined, or credit in general when we do a class, everything we have on our list today to talk about, I think I've had those questions at one time or another. So I think we should get started and start
debunking these
myths.
Start
debunking the myths. That's right. So I guess, one thing, and I'm sure it's happened to most everyone out there, one myth we hear is even if I'm one day late with a payment on any loan, credit card, mortgage, car loan, that will affect your credit score.
Yeah, we were talking about this earlier. I've had numerous calls over the years that I've been doing this of my customers that will call me while they're on vacation. And of course, there's a lot of preparation comes into vacation. Right. The one thing you tend to forget is to pay your bills. So I've had a lot of people that call me and frantically just saying, "Hey, what do I do? I obviously don't want to take my car or my house." And of course, we just reassure them, in most situations, especially at Ohio Valley Bank, we have a grace period. So you have an opportunity to go past your due date per se, that will be within that time period that we will not report to the credit bureau. In most cases, obviously, well, in all cases actually, you're not going to get dinged on your credit unless you're 30 days past due. So if you look at a credit file, what you're looking at is the ticker is 30, 60, 90 days. So as long as you pay that payment prior to 30 days, you'll be fine.
Right.
But just understand that there could be a late fee involved depending on your contract that you have with your financial institution.
Sure. Okay. You know, I guess maybe we should back up just a little bit, and if we could just give a brief introduction about credit. And there's 3 credit bureaus. Maybe you could explain who they are, what they are, maybe some differences between the 3.
Sure. Of course, when we pull as a financial institution, we're primarily pulling from 3 major credit bureaus, which is Equifax, TransUnion, and Experian. Again, that could vary as far as if they're pulling a tri-merge, meaning all 3, depending on the institution. We primarily pull from one unless we have a certain type of mortgage, we pull a tri-merge. But there's a lot of confusion as far as, you know, people think that there's only one out there and there's only one score. And each one of these companies, although have similar information, they have their own style or percentage of what is important to them. Giving you an example, I pulled some information off Equifax, and they weight their payment history, which is how well you pay your loan, of 35% of your score. Whereas if you went to TransUnion, they're going to weight it about 40% of your score. So that's really the difference between the companies, and again, the other company would be the same. They have their own little variation. And there always tends to be some confusion as far as why is my score different. So that's the difference between obviously the 3 credit bureaus and obviously what you may see at the bank and versus what you may see at home.
Sure.
Okay. So I know in the past we've talked about different ways that a consumer can go in and look at their credit and kind of monitor their credit on their own. We had some discussion about one of the programs that's out there now that's a free service is Credit Karma. You know, how often should companies or individuals go in and look at their credit, and is Credit Karma a good avenue to do that?
So I will tell you, you are obligated to get 1 free credit report a year. So you can go to annualcreditreport.com and you can retrieve that information. And what you're looking for, obviously, is all that information accurate. Now, if you're going to ask me how often I think you should pull it, I subscribe to, again, the same Credit Karma that you refer to. I even have an app on my phone, which is nice. And they alert me monthly and tell me go into it to see, review. I'm not necessarily falling in love with the score per se because it's a guideline, but I'm looking for all my loan products that are there to make sure that no one has opened up any kind of loan products fraudulently, so it doesn't impact me down the road.
Yeah. And the I just lost my train of thought, but so talking about credit cards a little bit and what credit could be on outstanding balances and whatnot on the credit report. You know, if you pull it through annualcreditreport.com, it does not necessarily give you a credit score. Is that correct?
Correct.
But just check it for accuracy.
Correct.
And then when you know, if you're looking at credit cards or outstanding, you know, if you had credit cards out there that you've closed, or had credit cards that you just paid off and didn't close them, those are the things you want to monitor. Is that correct?
Exactly.
Okay. Yep. And along those lines with credit cards, so maybe you could explain a little bit about how open balances can affect your credit score. You know, whether it's should we max the credit cards out or pay them all off, or and you know, how is it reported each month? And we had that conversation too. If you have a balance and you pay it off, does it necessarily get to if it's not reported through the credit bureau, does it show in the credit report? Those kinds of things.
So that's probably one of the biggest misconceptions I see in the industry is when people come in, they feel like, well, I've ran $8,000 of my credit card up, I've got $10,000 available to me, but I'm paying my bills, so it's not going to impact me negatively. When in actuality it will, because one of the ratios that any of the 3 credit bureaus look at is the percentage as far as your usage versus your available credit. So if you're at an 80% threshold, you're deemed as a risk. And even though you're within your limits you can have, that actually will impact your score negatively. What you're trying to get to is a 30% ratio. So if you had $3,000 on the same $10,000, it's going to increase your credit score, and if you can get below that, it would increase it even more.
Okay.
Okay. So one of the myths that we have here of closing a credit card will improve your credit score. So we just talked a little bit about open balances and things like there. So maybe that's not possibly true.
It's a yes and no question, or depends. I will tell you another factor that comes into your credit score is the length of your credit history. So if you were to close out a credit card that you've had for 10 years, they are factoring that 10 years in with all the other loans that you had as far as time. So if you close that out, that actually is going to hurt your credit score versus helping you. The only thing you need to take consideration, as we spoke earlier about, is if you're not using it, at what risk are you at? Because if you're not using or monitoring, then obviously identity theft is huge. If they capture that information and you're not monitoring your information, then they could run up that credit card and it could hurt you down the road.
Right. Yeah. And that's where pulling it every so often, every 6 months, every year, and just monitoring it for accuracy, that's where that comes into play.
Correct.
And you mentioned something when you were talking about that, is length of credit history. So, you know, I've got a daughter. She's a junior this year, not 18. But you know, I used to work in the branch in banking and do car loans and things, and you would have a lot of young people come in that maybe didn't have any credit history. So maybe you could talk a little bit about when's the right time to get started with credit and how that process would work, maybe with a cosigner, or just to get your credit started and get it built up.
Well, obviously, getting started can be a little difficult by yourself. You have to be of legal age before you can acquire credit.
Okay.
And the best way to get that is obviously go through a financial institution like Ohio Valley Bank. Yeah. In most cases, obviously, you're going to have 0 beacon score. So what you're going to have to do is you're going to have a signer with you, someone who has established credit and good credit score, that they can kind of go out on a limb for you and put their name down with you. So as you grow, then obviously through your financial obligation, then the next loan or loans after, you wouldn't necessarily have to have that particular signer.
Right.
Right. So a lot of us as parents with children in those situations, you know, it's best, or we sometimes feel it's best to give our child a debit card or kind of a prepaid card to use to buy their, you know, gas on or spending money. So maybe you're saying that maybe those aren't good ways to help build credit, right? They don't build credit. Yeah,
there is a misconception out there when it comes to debit cards. I know they're become very popular and they're very useful. I know I have a debit card with Ohio Valley Bank, and it's very rewarding to me because we have a rewards checking account that pays us 1% cash back. So I'm getting money and getting paid to use that card. However, it's not going to help your credit, because that's not a credit line per se. You're not getting approved, you're not going through the process and having a line of credit. So what you're looking for is some kind of credit card or car loan or whatnot. So although that is helpful to you and it teaches you obviously how to maintain a checking account, it's not going to transcend, and that information does not go over to the credit reports per se.
Right.
And also, you know, we're talking, you know, when lenders look at your credit report, they look at the content. The score is important, but they also look at all the content that's on there. An example would be, you know, when I was in lending, I had a couple come in, you know, they'd owned their home for 30 years, made payments on it and never missed a payment, had a, you know, super long credit history, and, you know, I think their credit scores were like 681 and 690. And then I had a you know, college student come in that had one credit card for like 6 months, and they made the payments, balances must have been right, and their credit score was like 710. So is that true? You know, when banks look at making credit decisions, they'll look at the credit report in general, not just the credit score.
Well, I can't speak for all institutions, but I can tell you at Ohio Valley Bank, what we're looking is at the body. You know, because again, if you look at the ratios, if you go to Experian or Equifax or TransUnion's websites, they'll guide you, and there's some information, education on there to tell you what percentages they hold valuable. and how it dictates your score. We're using this as a guideline, so they may, again, we talked about Equifax earlier, being 35% payment history is going to dictate the higher score, where TransUnion is 40%. When we're looking at the body of it, that score is a guideline. We're really going to dive into it and see if, what's making your score go higher or what's bringing it down. It could be something very simplistic. Maybe you missed a recent payment that's really dropped your score, but it was on a $100 credit card at Macy's.
Right.
So obviously we're going to have that conversation, make them aware, because they may not be aware, but we're still probably going to do the loan. We're just going to help them through the process of increasing their credit score.
Okay.
One question I had, you just referenced if you missed a $100 payment on a credit card for Macy's. Does that count against you almost equal to missing a $1,500 monthly mortgage payment?
Well, I'll tell you this, whether it's a mortgage payment or whether it's a credit card, anything that's recent will impact you negatively the most. Okay. So again, we talk about credit history, and bad things happen to good people. We make mistakes, we go on vacation, maybe we forget to pay towards the end, whatever it is, but we may miss a payment here and there. The thing you have to understand is you can get out of that situation. So although it may linger with you 7 to 10 years, depending on what we're referring to, but as that time gets further and further behind you, the score will actually raise up and up and up. So you can recoup that, the score that you lost when that happened. So it's not the end-all be-all. It will impact you negatively because it's the most recent. As you get further behind it, it'll be less impactful.
So I've had clients ask, and this is on your list, and I've actually had this asked to me several times. So credit scores, the myth is credit scores are locked in for a period of 6 months. And that's not true.
That is not true. And I had several clients that will come to me and say, 6 months ago I pulled my credit, it was X. Well, unfortunately, it could be higher or lower. We don't know until obviously we dive into the credit file. The credit score, the credit file, is a snapshot of pretty much that day. So if you were to pull today and then maybe next week pull, it could be different based on the balances that we referred to. Sure. If your available balance is more or less, it could drive the score up or down. Or it could come back to when the financial institution that you have a loan with, when they report. So the information is fairly accurate, but it's only accurate from the time in which they obviously pull, but it is not locked in for 6 months.
Okay. Good.
So let's say that we currently have bad credit.
We can get you out of it.
We can get you out of it, so it doesn't last forever.
Does not.
Yeah.
But how long of a process, if you were very diligent about redeeming yourself credit-wise, how long of a process is it going to take from the point, if you have pretty bad credit from a catastrophic event or something, to where you're a diligent person working on your credit? I know it varies customer by customer. I'll let you off the hook in that sense.
And that's a valid question. I have been lucky enough, again, for the 20 years that I've been with the bank, brought a lot of customers now who came into me early and had damaged credit, who we flipped the scale. So we've got them to where they have A credit, actually, and they had obviously as bad as credit as you can get. There's no magic time frame. It really comes down to what's in the credit file. Okay. So how bad is bad?
There's lots of different kinds of bad.
It's unique. Every credit file is unique. There's no two. It's like a thumbprint. Every credit report is different, and there's different ways and plans of attack. And maybe it's just because they've ran up a lot of credit card debt, and they've maxed them all out. Well, that's, I'll say, an easy fix, because you just got to stop spending and reduce the debt. Although it may be a lot of money, it just takes time to get across. So I can't really answer that question.
Well, yeah. For example, you could be, you could have just a couple small merchant credit cards, and you could have not made payments on them, but the balances may be $300-400 that you've been delinquent on for 2 years.
Yeah.
And those have really hurt you very bad on your credit. Or you could also be $100,000 in debt and have to dig yourself out from that. So you can be diligent in two ways, but one you can pay off a lot quicker than the other.
Yes.
And start digging out. So okay.
But there's always hope.
There's always hope. That's right. Absolutely.
So, say I do pull my credit report, and I think folks may see things on there that aren't necessarily credit related, in a sense, maybe like collections. If you had a cell phone bill that was outstanding from 10 years ago, or you switched carriers and a part of it didn't get paid, things like that do show up on the credit report, or medical collections.
They do, and it's important to note, it's not just if it's there and you haven't paid it. If you've paid it and it's shown as zero balance, it's still going to be there, because that stuff can linger, again, 7 to 10 years, depending on if we're talking about bankruptcy, collections, tax lien, and whatnot. So the negative information, even delinquencies, will, I'll call it, haunt you, but follow you up to the duration, obviously, of that time period. So
okay. And you mentioned something earlier about you pull your credit report to check it for fraud. If you do see something that's not accurate, what steps should you take to try to get it fixed?
Well, it depends on the situation. I will say if you've been compromised, you obviously want to contact the authorities, because you obviously your identity's out there. You're going to work with your local financial institution, and the great thing is you're going to go hand in hand with the 3 credit reports I referred to already, which is TransUnion, Equifax, and Experian. So there's options to freeze your account, so you can go in and make sure that there's no more fraud that happens. Unfortunately, it is a lengthy process, because you have to prove that this isn't your loan or whatnot. And again, it goes back to the point of making sure that you're following your credit report, or pulling it annually or as frequent as possible.
Yep.
So if we go in and check our credit score or check our credit, does that hurt us?
It does not.
It does not hurt the score?
There's soft inquiries and hard inquiries. So what I mean with that is, if you was to go in and actually pull your credit report through the annual credit report, or even through Credit Karma, you're not necessarily going to get I'll call it a ding on your credit. I mean, you're trying to get more credit. We, as financial institutions that we pull, we won't even see that. Now, if you go to financial institutions such as Ohio Valley Bank and you obviously apply for a loan, we're going to report that we've pulled your credit, and you'll even be able to see that. But a soft inquiry, which is what you're referring to, will not hurt your credit score. Too many of, obviously, inquiries when it comes to loans. So if you try to get a loan every month, then all those add up and could potentially impact your score. So I guess if I'm going to give you an advice at this moment, if you're going to buy. Don't try to buy every month, because again, every time someone pulls your credit, it could negatively impact you. Now, we're not talking 100 points, but every little bit helps.
A few points, yeah.
So if you go around to, like if you're shopping for a new car,
and
you go to 6 different car dealerships and try to deal on a car, and you actually get to the point where they're running your credit for a purchase to see what that bottom line dollar is going to be, you're kind of, it could be damaging to you.
Well, in that scenario, if you do it within a certain window, you're fine.
Okay.
There's regulations in place now that protects you from, obviously, every time, like you leave one dealership, go to the next, they give you a certain window of time that it doesn't necessarily pull you down. But my statement earlier, let's say you go shop for a car this month and realize I don't want a car, and next month now I want a car. You go to shop, realize I don't want it, and you pull every month, and obviously those add up. And those inquiries can stay on your credit report up to 2 years.
And so it's saying, so if you just went to one dealership and they said, let me see what rates we can get you, and then they fax that application out to 6 different banks, and each one of them pulls a credit report, that still falls within that window of protection.
Yeah, the easy fix, just come to us.
Right.
We'll
just go to one bank, have it in line, and be done.
Come to Ohio Valley Bank, we'll get you set up in line, you're good to go.
Absolutely.
But you are, again, you are protected if you were obviously to go to a dealership and they were to pull you, go to the next dealership. So again, there's a window of opportunity that you actually have to give you safeguard and won't increase or decrease your score.
Sure. Okay. Another question I get all the time is, my wife has good credit. Does that affect my credit score? Or, does your spouse's, does it have an impact on your individual? Does your spouse have an impact on your individual credit score? And I know in my case, my wife and I are on every loan, everything. I think she has a credit card, I have a credit card, and our points always vary just by 5 points or so. But just having the spouse on your credit doesn't necessarily mean it will affect it. Is that true?
No, because obviously your credit report is your own credit report. So now you may have joint accounts.
Right.
but is a snapshot of you, not of anybody else. So if you're married, obviously you're not going to have their credit pulled over to yours unless you actually signed on a loan doc together. But I'm a big proponent of obviously try to build both people's credit, because we live in a society now where dual income is important. So if you was to come to me for a loan, and let's say that your credit is great and your spouse's is not, but yet all of your debt is covered by both incomes, and if she doesn't qualify, can't put her on the loan, your DTI or debt servicing ratio is going to be low, and it may deter us from getting a loan just by yourself. So just keep that in mind when you talk about dual credit.
Right. And you mentioned income. Does your income affect your credit score?
It does not.
Okay.
It doesn't matter if you make $500,000 a year or $1,000 a year. If that information is not on the credit report.
Okay.
So your employer is the name of your employer. Your employer, when it comes to personal identification, your employer, your address, your social security name, date of birth, all that information. But no one reports your income, including your employer, to the credit report.
Okay.
Okay.
So now we know that a lot of employers use your social media accounts to screen for employees and see how you are. But do they ever look at your credit, or can they look at your credit?
They can look at your credit, but they can't pull your credit score. It's actually against the law for them to pull your credit score. However, they can pull the credit file and see what's in the credit file to determine whether they're going to hire you or not. But they do not pull your credit score per se, and they cannot deny you for your credit score.
Okay.
Another question I have. I know we're getting short on time, but it seems like every day you go to the mailbox and you get a credit card offer, or they say, hey, your credit score refers you or qualifies you for this. Those fall into that soft
inquiry. Yeah, they're obviously paying for that information. They know somewhat what's in your credit file. They're soliciting to you, but it is not a hard inquiry.
And they do not
will not impact your score negatively.
Okay. Yep.
Wow.
So lots of. And this is a conversation that could probably last another 2 hours.
Yeah, that's for sure.
So, is there anything that we haven't covered that you would like to share that you think is important?
No, the only thing I will say, again, there's a lot of information out there. You can go to TransUnion, you can go to Equifax, you can go to Experian.com, and if you go to their education part, you can learn all this that we talked about today, or see your local Ohio Valley Bank lender, and we'll help you through it.
Yeah.
So we've also got another note here, Chris. Maybe talk really briefly about your work with Habitat for Humanity.
Yeah, so we obviously, again, talking about the bank and giving back so much of our impact time, giving back to all organizations, but Habitat for Humanity does a great job within all of our communities. Every year we are partnering up with them to put a team together to get a little sweat equity out there and try to help out the community all we can. So.
Okay.
That's great.
Great. Yep.
Well, Chris, we really appreciate you having you on the show again this year. And
Thanks for the information.
Always very informative.
Lots of information.
It's always a little scary, but it always lets us know that there's hope for the future, that we can recover from maybe some of the bad choices and bad decisions we've made in the past.
Yeah,
so
that's true.
Yeah. Credit's like life, right?
That's
you can always recover.
Always bounce back.
That's right. So anyway, until next time, thanks for joining us here on Common Sense. I'm Brad Bapst.
I'm Ryan Mapes.
And we'll see you next month.